The following is a paid program sponsored by Market Advisory Group.
Is AI crashing the economy? No, but it's quietly changing the rules, and the effects could surprise you. Artificial intelligence, it's making companies leaner, faster, and more efficient. That sounds great though, right? But here's the twist. When businesses can do more with fewer people, do they need to hire as many? And that can change everything. I'm Matt Goolsby with retirementhelp.com, and we're here looking at how AI is reshaping the market around your retirement nest egg on this episode of Eye on Retirement.
In today's world of market volatility and uncertainty, your retirement plans need to be front and center. With ever-changing tax laws, healthcare worries, and an unpredictable stock market, don't overlook the vulnerability in your retirement planning. Protecting your family and estate will be difficult with shifting policies in Washington. It's more important than ever to keep an eye on retirement.
Hi. Our latest GDP number, it came in at 4.3%, and that was higher than expected. So on paper, the economy, it looks strong. But if you ask people how they feel, the answer is very different. Why is that? It's because growth isn't being driven by more jobs or higher wages. It's being driven by efficiency. And see, companies are producing more with fewer people, all thanks to AI and automation. That disconnect between the headline numbers and lived everyday experience is the story we need to talk about. Think about it. Fewer hires means slower wage growth. Slower wage growth means cooler consumer demand. And yet unemployment stays low. So the economy looks fine on the surface, but underneath the engine is running cooler. See, growth can feel softer, and traditional indicators, they're probably not telling the full story. See, this isn't about mass layoffs, it's about a structural shift. Take this study, for example. A recent Federal Reserve Bank of New York survey found that 40% of service firms and 26% of manufacturers reported using AI in the year 2025. Very few reported AI-induced layoffs, but many have said they're scaling back hiring because AI improved efficiency. Retraining was more common than job cuts. That's a silent shift happening right now in our economy. Here's why this matters. When efficiency rises, yes, margins can improve, but the hiring is probably slowing. And that can impact consumer spending, corporate earnings, and ultimately market performance. PwC estimates that AI could add $15.7 trillion to the global economy by the year 2030. McKinsey says up to 30% of tasks in 60% of occupations could be automated. Those numbers sound exciting, but they also mean the old growth patterns we've relied on for decades could be changing. So what does this mean for you? If your financial advisor hasn't been asking you or talking to you about AI's impact on your portfolio, it's time to ask. AI isn't just a tech story, it's a macro story. It affects valuations, growth sectors, and long-term strategy. And here's the good news. You don't have to figure this out alone. We've created a simple way to help you start planning for this shift. It's called Step 1. It's a 15-minute conversation, and you can do that by phone or in person at one of our classes, but you can call by scheduling that, or you can schedule that 15-minute call by calling 833-44-CORE4 or visit retirementhelp.com. Whether you're 5 years from retirement or already there, understanding how AI impacts your financial future is critical. The time to prepare is now, because disruption isn't destruction. It's transformation, and the future belongs to those who act. Stay tuned. We'll be right back with Doug Miller right after this.
Out on the water, there is a moment. Perfect synchronization. The team working together in harmony to reach their goal. Now, imagine finding a team of financial professionals to help run your course down the river of retirement. Market Advisory Group is that team. Financial advisors, tax professionals, estate planning attorneys, and Medicare advisors. All in the same boat. If you don't have a team like this in one place, it can become a hassle to relay information between them. When you come to Market Advisory Group, we bring everyone together for you. To get you answers in real time. To help make sure you don't miss something that puts your unique plan off course. You shouldn't be the one doing all the work to keep your retirement on pace. You should have a team in the boat with you. Your voice telling them where you're at, where you'd like to end up, and how you want to get there. And at that point, everyone falls into sync, all pulling in the same direction, toward the same purpose. Your retirement's financial security. We are Market Advisory Group, proud sponsor of Shocker Rowing.
Welcome back into Eye on Retirement. Joining me now is Doug Miller, a financial advisor with Market Advisory Group. Doug, thanks for being here.
Hey,
We're going to continue this conversation about AI, and I want to think about the big picture impact. AI, it's a long-term trend. It's not a fad, wouldn't you say?
Oh, absolutely. What some of the experts are talking about it is that the infrastructure build out, the data centers that we're hearing about, that's a 10-year. They're giving it a 10-year projection now. They're estimating, we've been doing this for about 3 years now, building stuff. So there's a lot of, we're still in the early stages of a long-term trend.
Kind of going to be like a pig through the python, so to speak. So there's going to be these ripple effects that happen through different areas, and there's going to be a lot of disruption. But the investors, they shouldn't panic, though. They should adapt, right?
Oh, absolutely. I mean, there's going to be a lot of change. There's going to be a lot of opportunity going on. I mean, if you think back to the era when, the 1990s, when the internet came up, everyone was panicking. Nobody quite knew what was going on. And we've adapted and we've moved on. Sears has sadly gone the way of the dodo, but now it's replaced with Amazon. So things will change.
Talk about panic, Y2K, they got all the craze around that.
Absolutely.
It's scary. Change can be scary, but you need to focus on the fundamentals, right? You need to be diversified, and you also need to have probably some risk management along with those long-term goals, wouldn't you say?
Oh, absolutely. I mean, I think you probably are sufficiently diversified now because it's going to affect the whole S&P 500, but you need to make sure you are. You need to look into it.
It's going to be disruptive, for sure. That's probably the understatement of the decade, how disruptive AI is going to be. But where does AI show up in portfolios? It touches multiple sectors, wouldn't you say? Healthcare, logistics, finance, manufacturing, all the different sectors like you're saying.
Pretty much everything. I mean, there's the first order that people have been, we've seen last year, it was all about chips, it was all about building the infrastructure. Now we're going to get into second and third derivatives. You're going to see many companies just become much more efficient. I was listening to something about the oil industry the other day. They're bringing their cost per barrel down because AI is allowing them to find oil and get to the oil quicker.
Interesting. You hear every day another use of AI in different areas, and it is having an impact. So, but when you're looking at trying to invest, should you avoid maybe chasing one stock or industry? Because when you're retired, that volatility, it can wreak havoc with your nest egg in retirement.
Oh, absolutely. I mean, I think whatever the driver is, the nest egg, your goal is your goal. It doesn't matter whether you're chasing precious metals or the like, but you should have your goal. Your goal is not to try and get 3 times 300% return. Your goal is to meet your retirement needs first. And how we do it then secondary, AI was one way to reach those goals.
In AI, there's been a lot of companies in the news that some companies having quite the run, but what goes up fast, I've found, can go down fast. So if you're trying to invest and catch the new trend here and make sure you're adapting for how AI is going to be disruptive throughout retirement, how should you consider investing? Should you consider like maybe broad exposure through diversified funds or ETFs, or would you maybe say single stock is the way to go?
Okay, so that's a big question. That's an interesting question, and I think both of those answers are relevant. So you definitely should have a diversified portfolio, but it's also good to keep your interest, maybe have a little lottery ticket, a little one, something to keep your attention. So I do think, but again, like a lottery ticket, you don't put all the rent money on lottery tickets. You put a little bit on it.
I think we just like hearing you say lottery.
Okay, fine. Yeah, I'll say it again.
No, but really,
you put it in a reel.
It's all boils down to really the risk tolerance of the individual. I often will refer it to as salsa. How hot do you like your salsa? And yes, like you said, there's probably a portion of your nest egg that you might want to consider a little aggressive, maybe have a little aggressive pot of money, but probably all single stock exposure is going to add, of course, more volatility to the nest egg. So investor behavior. So we probably would say avoid emotional investing, wouldn't you say?
Oh, absolutely. You want to avoid that because again, you're chasing other people, you're chasing things. If you do your own due diligence, you can take that emotional edge off it and say, okay, is this really something? That's an emotionally, you're chasing someone else's success.
That's right. And so you have to have a plan and, stick to that plan. And you need to be also working with an advisor to understand how innovation can fit into your strategy. Because maybe, like we said, maybe there's a portion of the nest egg that there is an acceptable amount to maybe risk out there. Maybe not, depends on your circumstances. But if you're not looking forward to how you can participate in this disruption of AI and how you can maybe take advantage of it, you're gonna be wishing you probably had, because it is being very revolutionary. So the practical next steps would be what? Maybe review allocations?
Absolutely. Review allocations and have a look at, you talked about risk, but if there's like 1%, that's a tiny amount of risk versus taking everything out. And even if you don't want any risk, or maybe you want more, maybe you're comfortable with more, you do need to sit down with someone like, myself or yourself, who's going to be less emotional about it.
Are you a fiduciary?
I am fiduciary.
Well,
yes.
you withhold yourself to the fiduciary standards. So you need to review that current allocation with the fiduciary and make sure that you are diversified and understand the exposure to the different growth sectors. And how would they maybe do that? Would they schedule a 15-minute conversation with us? Is how they would take that first step, right?
Absolutely. A 15-minute conversation will be the start of that, leading into a longer conversation. But a 15-minute, that's, as they say, every journey starts with the first step.
And so, guys, if you're watching this out there and you're not sure how you're poised to participate in this next wave of the economy and how it's going to be very transformational, all you have to do is reach out and schedule a 15-minute conversation with us by phone. You can call 833-44-CORE-4. That number again is 833-44-CORE-4. That's for the core 4 areas of retirement. Or you can visit retirementhelp.com. In our next segment, we'll be talking with Trey Basa of Market Medicare Insurance about IRMAA and what it really means. Stay tuned for this sneaky tax with more Eye on Retirement right after this.
Every client we work with deserves a custom-made plan to fit them.
We can take any situation that's thrown in front of us, look at what fears they may be trying to work through, and come up with very creative solutions.
We are unique to people that are seeking to try to have the complex things more simple.
We work together as a team. As an advisor, it'll come up with tax questions. It's great to have a CPA here in the office that can answer those questions and give them accuracy.
Market Advisor Group, proud to be local.
Retirement is supposed to be exciting, the reward for decades of hard work. But for many, it starts with a flood of questions. When should I take Social Security? How will taxes change when I stop working? What do I need to know about Medicare? And what happens to everything I've built when I'm gone? Retiring isn't just about leaving work. It's about stepping into a whole new season of life and making sure you're ready for it. That's why there's retirementhelp.com, a free online resource built specifically for people just like you. Clear, trustworthy information on the decisions that shape your retirement. RetirementHelp.com is here to empower you with the resources and education you need to retire with ease. What sets RetirementHelp.com apart from other resources is how we view retirement planning. We believe it takes a team, because taxes can affect Medicare costs, and finances can affect estate planning. We take a holistic approach to retirement, so you don't have to bounce around like a pinball to get your questions answered. We have articles designed to answer questions you may have, webinars that dive deeper into topics like Social Security and taxes in retirement, videos, TV shows, and podcasts exploring real-life issues retirees have run into, as well as daily updates addressing changes in the retirement landscape. Don't let doubt keep you up at night wondering if you're ready or not. Visit retirementhelp.com today and start planning the retirement you deserve.
Have you heard about what I call this sneaky tax? IRMAA. It stands for Income Related Monthly Adjustment Amount. But what if it really means higher Medicare premiums? Well, if your income crosses certain thresholds, it acts like a sneaky tax. Here with me to discuss this sneaky tax is one of the health insurance advisors with Market Medical Insurance, Trey Basa. Thanks for joining me today, Trey.
Happy to be here. Thanks for having me.
So briefly run down, what is IRMAA? We want to talk about this in layman's terms because we use all these technical terms, and I think sometimes we lose people in that technical jargon. Boil down for us, what is this IRMAA?
Okay, so I think sneaky tax is a very accurate term for it. What happens is the federal government looks at an individual's tax return from 2 years prior. So we're in 2026. They're going to look at your 24 tax return, how you filed. So either married, filed jointly, single, etc., and how much you filed for. That's going to be your modified adjusted gross income. They're going to look at those two aspects. They're going to see that number and they're going to say, okay, this is your Medicare premium.
So that's not last year's income, but it's probably like the previous year's income.
It's always a 2-year look back.
Well, that's convenient. So why is this sneaky? I mean, would you say that based on that 2-year thing, it is sneaky that way? I mean, that's kind of how I'm taking. You're not really thinking about what your income was 2 years ago very often.
No, and that's part of the sneaky aspect. Oftentimes people are doing what they're doing year in and year out. They're not taking a look at the larger picture of what is going to cost them 2 years from now, 5 years from now. That particular time frame is very tricky for folks, especially approaching retirement, because as they are reaching the highest earning years of their careers, now they're looking to retire. Now they're looking to make some moves to put themselves in a better position for the rest of their days. And now all of a sudden, we're looking at what does that cost boil down to before you leave workplace, before you leave workplace insurance.
So this is based on like the income for 2 years ago. So today's decisions can affect future costs, is what I'm hearing.
Precisely, and it's not only a one-time look at your tax return and what that is going to do for you 1 year. It is always going to be a 2-year look back period. Not just today, but for the rest of their retirement. They have to be looking 2 years in the future. They have to be taking a look at what some of these thresholds are and staying under these thresholds so they're not paying an exorbitant amount for Medicare premiums.
Now, one of the mistakes I see a lot of people make when they do Roth conversions is they don't realize this is going on in the background. And there is a disconnect here. I mean, you're a health insurance advisor. I'm a financial advisor. I don't know whose responsibility it is to talk to them about this, or maybe it's the tax person, guys, but really it's the retiree's responsibility if they're not all working together. And these Roth conversions, when I see people make mistakes, they don't factor in this tax.
Ultimately, it boils down to the retiree and how they're going to make that happen. Now, we are advisors. We can't tell them what to do, but we will give them the best advice that we can to get them to the point where they're comfortable making some of these moves.
So when we're thinking about who's really at risk for this, because I don't know about you guys, but when something is going to cost me more money, I want to know when and how it could cost me more money. So pay attention here. when we're having this conversation with Trey Basa, health insurance advisor with Market Medical Insurance. Excuse me, you guys just recently did a name change. Still learning that one. But who's most at risk here? So, I mean, is this my mom who's just on her Social Security and gets a small pension, or is this, is this the guy that's saved $1 million+ in retirement accounts?
It's gonna be the latter. Folks that have been building this nest egg for decades, and they are what's the term? They're building pre-qualified accounts.
Oh, pre-tax, yeah.
Pre-tax, yes.
The IRAs, the 401ks.
Yes, these accounts, they have not been taxed yet. And when it comes time to take a distribution, you get access to that money. Or a lot of people are doing Roth conversions. They have to pay taxes on it then. Now, all of a sudden, that counts as taxable income, goes on your 1040, which is going to influence your Medicare premiums 2 years down the line.
So then think about it too, like those large pre-tax retirement accounts. Say if you got a $2 million plus IRA, all pre-tax, and you reach that age where you have to start taking money out of it, it's more than $70,000 in what's called a required minimum distribution. And again, that $2 million pre-tax retirement account, it can start kicking your income up pretty high, depending on if you're married or single. You could trigger IRMAA pretty quick.
So now we're on the opposite end of the spectrum, right? Where we didn't convert all $2 million right away, going right on the tax return, but now we're not taking enough out. We have that RMD, that extra 70,000, not even for an individual. It could be for two folks in their individual accounts.
Sure.
Both have RMDs going into the tax return, influencing both of their Medicare premiums.
And you and I know there's tons of things you can do tax planning wise to maybe unwind this tax bomb that are in pre-tax retirement accounts. And so basically, to boil it down simply, just like you'd have investment diversification, you wouldn't want all your investments in one basket. You wouldn't want to own all one stock, in my opinion. You want to be diversified. Tax diversification matters just as much. And when I see a lot of retirees out there, they don't have a lot of money in after tax. They have a lot of it in pre-tax, and they don't have much at all, if any, in tax-free retirement accounts. Wouldn't you say?
Yeah, it's very common to see that folks that have been working, that they've been putting aside a percentage, that pre-tax account, you can only do a certain amount every year. And then like once you're 50 plus, you can do a little catch-up contribution. Like there's a lot of ifs, ands, or buts, lots of fine lines to walk around. But now all of a sudden, people are ready to retire. They're ready to leave work and start enjoying their golden years, right? When it comes to that time, this is where it becomes a sneaky tax. It becomes that tax bomb that could blow up in the future. People need to sit down and start thinking a little bit further ahead, at least 2 years in my opinion, because this IRMAA tax is going to be painful in, say, 2 years. It's going to cost folks more every month for Medicare premiums, and it could be for years to come.
So that's why you call it that sneaky tax, because it really doesn't show up on the tax return. It hits people in their Social Security payments, because how this typically works when you trigger it is you get a letter in the mail. Normally, when I've seen people get it, it's October, November, and they say, hey, we're gonna withhold 75, we're gonna hold 100, we're gonna hold 400, we're gonna hold whatever the penalty is. We're gonna withhold that out of your Social Security payment starting in January. And a lot of people call confused and say, what is this? And it's unfortunate because I was mentioning this earlier. To me, who's the responsible party to help the retiree with this? Is it the health insurance advisor? That would be you. Is it the financial advisor? That would be me. Is it the tax advisor? And the reality is, it's the retiree. And tragically, the retiree never figures this out until they get that letter.
Yeah, it's kind of a shock to reality. They say, they receive this letter and they say, what is this? Am I really going to have to pay 2 times the amount of Medicare premiums, almost 3 times the amount? And I'm going to have to do that for a whole year.
And I don't know about you, but what was that big government shutdown all about? Healthcare costs, right? And
There
they
was
still
big
haven't fixed it.
debates. No.
And this actually premium tax, I can see. I mean, do you think taxes are going to be low forever?
I do not. Sorry.
Yeah, right. And so these pre-tax retirement accounts, they're ticking time bombs, not for just for future tax purposes, but now you're saying it could cost more for people's healthcare insurance and like Medicare Part B and D.
Yeah, we really need to make sure our clients know that it's not just about the money. It's not just about their health. There's going to be a lot of influence between all of these aspects of their retirement that is going to cost them in the future if they don't start putting a plan together.
And really, I'd take it a step further. I think they need a team because as government regulations change, as tax laws change, whether for the good or the bad, as estate planning techniques change, all these things can have an impact. And a team approach means an integrated planning approach, and the retiree isn't stuck out there as the middleman. And that's what we find when people have triggered this IRMAA. They're out there as the middleman.
Yeah, like we said, it really boils down to the retiree's responsibility. And as a lot of advisors here, we don't want folks to do it by themselves.
That's true. That's true. And they don't have to. And to take that next step of not having to do all this alone, it's picking up the phone and calling 833-44-CORE4 and scheduling that 15-minute conversation with a member of our team. And again, you can have that conversation by phone, or you can come in person. We also have those in-person classes around the metro. Don't forget about those. Again, call that number 833-44-CORE4 or visit our website, retirementhelp.com. That's 833-442-6734. We want to let you know we're here to help you with all things in retirement, and also reminding you that we're here to keep an eye on retirement.
The proceeding was a paid program sponsored by Market Advisory Group.